a little question. So the question is, how much are we able to predict the future? So let's just say, so I'm standing on this podium right now, and I can see two emergency exits. So if suddenly there was an emergency in the room, and I decided, my instincts take over, and I decided to head for the emergency exit, which one would I go for? So this one is obviously the closest. This one is a bit further away. On the other hand, I know, because that's the way I came in, I kind of know what's on the other side of that door, but I could assume that although I haven't been that way, it's probably a safe exit. So here's my question. Imagine there's suddenly an emergency in the room and I'm going to head for the exit. Hands up if you think I'm going to go for this exit over here. Hands up. Okay. And hands up if you think I'm going to go for that exit over there. Okay, that's interesting. That's interesting. Of course, you guys can't read my mind, so although you may have an internal calculus, internal thinking about which way I'm going to go, basically you're just guessing. Okay? So here's another second part of the question. So if there's emergency and I head for the doors, you're kind of guessing which way. Now, imagine I just step off this. I'm on a podium. It's a couple of feet. If I just step out into space here, what's the likelihood that I'm going to hit the floor versus the likelihood that I'm just going to stay suspended in the air? So hands up if you think I'm going to hit the floor. Okay, so why do we think that? Because we're predicting the future. You know, I might walk, but why the hell am I not going to hit the floor? Well, that's gravity. So we're pattern matching, basically. We're not necessarily predicting the future, but, you know, our lifetime experience has told us that generally gravity does its job. And, you know, maybe I'm a stage magician and suddenly I'm on some strings that you can't see. So there's a very, very, very small chance that you might be wrong, but more likely than not, the pattern in our heads says we're going to hit the floor. Okay, so is one guessing the future or one not? You know, what does guessing the future mean? If we've got a set of rules in our head that generally kind of work, that's really pattern matching. But if you're trying to guess what's in my head, that's really predicting the future. Now, if I was Donald Trump, could you guess what's in my head at any particular point in time? No. So, kind of what's the point? Okay, just hold these thoughts. Let's move on. Okay, I'm going to start. Actually, let me go forward. Okay, yeah. So, title of this talk is Financial Resilience, and it's about preparation, not prediction. Because most of the time, we really can't predict. Sometimes we can pattern match, and we'll be talking about that, but most of the time, we can't predict. Okay, I'm going to start with what is a recession. As Ren said at the beginning, worries about recession, economic concerns, what's going on in the market. There's a lot of stress going on. And already this morning I've spoken to people who say, I'm a bit worried about our portfolio, can we have a look at that? Well, let's just catch our breath and say, what exactly is a recession? Now, this backdrop on this slide, I clipped it last night. I just went to Google Images and typed in recession, and I got all of these things. It's an arrow going down, which is presumably supposed to indicate the market is going down. And in fact, out of 14 or so slides here, each one of these is an arrow going down, except for this one and this one, which was economic cycles. Now, the interesting thing is, the definition of a recession has absolutely nothing to do with the market. It's nothing to do with the market. So you type in recession in Google and you get a whole load of market charts. Now, of course, there's a connection, but the definition of recession doesn't include anything to do with the market, which is kind of a bit weird, really, and that's one of the reasons why we sometimes get ourselves too stressed. Okay, so what actually is a recession? So generically, and I think I just got this from Wikipedia, but we all in the industry, we all know. I'm going to move over here. Basically, generically, a recession is a period of time, extended or sustained period of time, when economic output falls, so GDP is falling, and unemployment rises. And broad brush, that's a kind of a generic description. Now, many of us will be used to the sort of the common definition, which is used in many developed markets. A recession is defined when we've got 2 quarters, i.e. 6 months of decline in GDP. So economic output of a country, a nation, has declined for 2 quarters. That's a kind of a rule of thumb definition of a recession. In the US, they like to do things a bit different. They've got this thing called a bureau called the National Bureau of Economic Research, and their business cycle dating committee is the board that meets and decides whether there is actually a recession. And they look at a lot of different things. They look at, the employment levels, income, sales, industrial production, and then they make a decision, yes, we're in a recession. But more often than not, it's, yes, that was a recession, because GDP is a lagged indicator. Like, we only got North America, we only got US GDP data at the end for the first quarter at the end of April, and it will be the same. And again, there's always a lag between real GDP numbers and the start, if there was a start of a recession. So let's just move on. Sorry, I have to play with my clickers here. Okay, here's a good example of what I was saying. Okay, so this is the S&P 500 going back to the 60s. The grey bars are recessions, formally identified by the NBER as recessions. Now, there are periods of time when recessions are definitely coincident, like the global financial crisis, with falling stock prices. There are also times when the recession actually just happens to be in the middle of a long-term, a downward trend. This is the dot-com. But there's also, weirdly, periods of time when, during the period of recession, and I've zoomed in, actually stock prices went up during that recession. And here's another one. Around 1980, stock prices went up, although it was a recession. So this is just kind of underlining that, yes, there's kind of like a connection between stock prices and recession, but the connection is a little bit indistinct. And there's that comment, in general, the NBER, it takes them at least 12 months on average to say, yeah, by the way, guys, that was a recession we were in. Okay. On the other hand, here's the unemployment chart. So the same, the same time, that worked, I wasn't even pointing at that area. The same time scale, you can see the grey bars, the recession bars are pretty, but this is the US unemployment rate. Now, what do we notice? Every time that we get a surge in unemployment, it's almost identically coincident with the officially declared recessions. So so there's the dot-com, there's the global financial crisis. We kind of had a blip of recession during COVID, but every single time there's been a surge in unemployment, that's coincident with a recession. So in a way, something like the unemployment rate, real people, real jobs, worrying about surviving financially, this is the kind of thing that's much more of a useful indicator to think about recession. Okay, so very briefly, we can say that the economy, GDP, is driven by real data. It's measurable. Surveys come out, people crunch numbers, but it's slow moving. It's slow moving. We might have to wait months or quarters before we actually know what the data says. So it's very much a rear view mirror when we're looking at economic data. On the other hand, the market, stock prices, both nationally and internationally, it's sentiment driven. Trump can open his mouth and say everything is fabulous and prices go up. Or Moody's can downrate US debt and everyone's depressed. You know, so it's and it can turn on a dime, to use that Americanism. It's sentiment driven. It's driven by headlines, because the stock market is basically a forecasting machine. Stock market, if people are optimistic, it drives prices upwards. If people are pessimistic, it drives prices downwards. And whether we're optimistic or pessimistic, that's just our personal feelings. It doesn't necessarily relate to what is actually going on in the economy. So I'm just going to go through this very quickly, just what is the connection. So if we start up here, let's say the economy is expanding, everything is going great, GDP is going, consumers and businesses are spending more. Higher spending basically means higher sales, more company profits. If companies are making better profits, their value goes up as business, and that's attractive to investors. Assuming that we've got a healthy economy, investor interest increases demand for buying stocks. Demand for stocks pushes up stock prices. And rising stock prices gives us that sort of sentiment feedback loop. Our pension fund is doing better, so we feel a bit more wealthy. We're maybe we'll go out and spend a bit more money. And then the cycle repeats. But the most important thing to bear in mind is that this cycle only repeats as long as GDP keeps growing and we've got favorable economic conditions. Here's the economy. So I found, I don't think it's in the sea now, but I found a photo of what was at one time the largest supertanker on the planet, almost 0.5 kilometer in length. Too big for the English Channel, Suez Canal, the Panama Canal, a turning circle of 3 kilometers and a stopping distance of 6 kilometers. So this is quite some beast, and it doesn't react quickly. I'm just going to ask, because I was wondering, do we have any like ship's captains or anyone with a marine or a nautical background in the room? We do. So if we're on a monster like this and you suddenly want to make it stop, I can imagine you have put the engines in reverse and it takes like half an hour before you start to see any change in the forward momentum. Am I right in that? A little bit less, okay, but something along those lines. Thank you. Okay, here's the stock market. So the stock market is the mini clubman. Length 3 meters. Turning circle, less than 10 meters. Stopping distance, 30 meters. These guys literally can do a U-turn on a normal width street. Now, if we've got a Mini Cooper that's sitting on the deck of our supertanker, and I remember reading it, I searched on the internet, but I couldn't find it. I read it before the internet. There used to be a supertanker that had a Mini on it because the captain used it to drive up and down the deck. But it doesn't matter which way you're driving, whether the Mini Cooper is driving forward or backwards. What really counts is what direction is the supertanker going. And that's the way to think about the connection between the market and the economy. The economy is the underlying direction of that supertanker. It's slow, it doesn't turn quickly, we might not even notice for a while when it has already started a turn, whereas the Mini Cooper, up and down, like anything. Okay, I just put this slide up here. I'm going to try and not get too technical on this, but this to me, if we can imagine what we've got here is we've got the market. So the market is our Mini Cooper and the economy is our supertanker. We've got the market over the economy. And really poetically almost, this is called the Buffett indicator. Warren Buffett once said it's one of the most useful indicators to get a general idea about whether the market was overvalued. So this is the ratio of the market measured by the value of businesses, which is market capitalization, which is based on stock prices, the market over GDP, i.e. the economy, economic output. So this is a chart of market valuation versus the valuation of economic output. And you can see it was at a peak, so this is the long run average, you can see it was a peak during the dot-com. But for the last few years, basically since just after COVID, it's been quite elevated. Now, we're not trying to read necessarily too much into this, but it kind of gives us a little bit of background that, you know, that maybe if there's going to be some surprises in the stock market, they're more likely to be on the downside than they are on the upside. It's just something to bear in mind. I think it's a very elegant way of getting a big picture. Okay, here's another big picture. So we've been talking about GDP. Is GDP useful at all or forecastable to give us an idea of whether we're actually going to see a recession? So this is the IMF projections. So the International Monetary Fund, they release their regular updates for the global economy. And back in April 2008, they forecast the GDP of 2009. So this is April 2008, forecasting for the next year. They said next year is going to be good. We're going to have global growth of 3.8. A few months later, they revised it. They said, actually, it's going to be better than we thought. It's going to be 3.9. By the time October comes, they said, you know what, actually, probably it's only going to be about 3. By November, they issued a special update. You see, there's only a month between those two. Special update, actually, GDP growth next year is only going to be 2.2. And you can see I've overlapped these remarks on the S&P 500. Now, at the time, the IMF, their kind of like rule of thumb threshold for whether or not there's going to be a global recession was 3%. So basically in November, the IMF was saying, guys, we might be in a recession. Now, interestingly enough, so there's that NBER, this is the USA. So in December 2008, so about this time here, they said, you know what, guys, we're actually in a recession. And by the way, it started back here in December 2007. In the meantime, so the top line there is 0. In the meantime, the stock market, the S&P 500, was down 45%. So trying to use GDP as a rough measure is completely useless for giving us any kind of forward indication of what the stock market holds for us. Okay, here's the GDP equation. So GDP, economic output of a nation, is consumption, so that's consumer spending, household and non-profit spending, investment, government spending, less net exports, so exports minus imports. Now, I'm only putting this up here because the major item, consumption, consumer spending, is the biggest one. So let's just have a look. So consumers are the economy. Consumer spending is what drives the economy. And in the United States, GDP of 30 trillion, that represents almost 27% of the global economy. But interestingly enough, over 2/3 of that number is just consumer spending. And for the rest of the top 10 economies, with the exception of China, which is below, all of the other nations in the top 10 economies, consumer spending represents more than 50% of their GDP, of their economic output. Okay, why is this important? Because the 10 largest economies, between them, account for 2/3 of the global economic production, the global GDP. So if something happens to consumer spending just in these top 10, that's 39% of global GDP at risk. And by the way, if we just multiply those two numbers together, we get about 19%. Consumer spending in the US alone is about 19% of global GDP. So we need to pay attention to consumers, how they're feeling, how they're spending. Okay, let's do that. So in the United States, the Conference Board and also Michigan University regularly produce their consumer confidence survey. This is April's from the Conference Board, and I haven't given you the big CCI, the main CCI, but components of it include something called the Expectations Index. And the Expectations Index is an index that represents how consumers, how the householders are feeling about the next 6 months or so ahead. Okay, so it includes things like employment prospects, it includes household income prospects, it includes their view on the general business environment. So it's a survey, they ask real people, how do you feel about things for the next 6 months ahead? And April's data just fell like a stone. Okay. Now, interestingly enough, the last time it fell so far so quickly was pattern matching, not predicting, just pattern matching. Who knows? But the last time it was before the global financial crisis. Okay. But what this is saying is consumers are stressed. Consumers are really, really stressed. That's a signal that you can't ignore. Why are consumers stressed? Let's look at a few things. This is the US housing affordability gap. So the blue line, again, this is April's data. The blue line is the actual median income of American households. The orangey line is what's called qualified income. This is the income that you as a household need to have so that you're spending no more than 30% of your income on your housing. And the gap has gone absolutely crazy. The gap is really through the roof. What this is basically showing right now is that families, millions and millions of people cannot afford their housing right now. That's massive. And look, the last time we saw this big gap, just before 2008. What happened to the housing market at that time? We can all remember. But who knows what happens next? Again, we're not predicting, we're pattern matching, but more likely than not, things are going to move to the downside. What does that mean? That means a decrease in the housing market. Okay, let's look at household debt. Most households have debt in the same way that most governments do. So let's look at credit cards. Look at this card. This represents the percentage of balance of US households credit card debt. So as of, again, this is last 2 weeks old data, and my pointer is gone. Can I? I've blown the battery out. Whoop. No, that's the laser pointer that. Whoop. I'm going. Go back. Okay. Can I borrow the laser pointer? It's back again. Yeah, it's the battery going. Okay. So let's just look at that. First of all, credit card debt in the US is. Do we have another laser pointer? It's here. I've got it. Wonderful. I should. Sorry, Ren. Okay. Credit card debt at the moment, right now, is about 1.2 trillion, which is the highest it's ever been. And more than 10%, so something like 11% or so of that debt is in accounts, credit card accounts, that are more than 90 days delinquent in paying their credit card bill. So we've got $120 billion isn't being paid down on credit card debt. And look at the current trend here. The last time we saw something like that is around global financial crisis. Same with car loans, not quite so pronounced, but this is absolutely showing that consumers are stressed. If you can't pay your credit cards, that's stressful. And here's the total balance. Okay, so if you add up all the delinquency status, 30 days, 60 days, 90 days, 120, everything, global national debt in the US households, we can see. So there's that curve running up to, picked up the wrong one. There's the curve running up to the global financial crisis. Who knows what, we're not predicting the future, but maybe we can pattern match a bit. Okay, I actually put this slide in the wrong place. We'll come back to that in a second. So this, I just dropped this in. This is 5 days old, this data. This is from the University of Michigan. This is consumers. The red line is the one to look at. This is the percentage of consumers who are surveyed expecting more unemployment during the next year. So the survey asks, do you think the job situation is going to be better or worse in the next year? And that number is now 65% saying things are going to be worse. Now consumers know. You know if your town is hiring. You know if jobs are easy to get. If jobs look scary, if you're worried about losing your job, you don't move. Shelter in place in your current job. You batten down the hatches. You reduce consumer spending. Okay, and this is showing. You see this peak pattern matching. What happened the last time we saw that shoot up like this? It was the dot-com bust, the boom and bust. It was the global financial crisis. We had a little bit of one in COVID, but COVID happened so quickly, consumers were caught by surprise as well. But this is really important. Consumers know. We're not guessing the stock market. We're not trying to guess what's going on in Trump's mind or any of the other world leaders. Consumers know what's going on in their town. They know how easy it is to get jobs or otherwise. So when we see this kind of spike, should we expect a grey bar? Maybe we're already in recession already. GDP in the US for the first quarter was negative by 0.3. Maybe that's all because of imports, who knows? Okay. So I'm just going to show you something. Oh, there's that unemployment. You can. Okay, there's this slide. So this was a technical paper issued in 2017, and they carried out some statistical research on consumer confidence as a leading indicator. We've already said GDP itself is useless because it's so lagged, but consumer confidence, changes in consumer confidence, i.e. consumer mood, can cause changes in consumer spending, which in turn influence GDP with a lag of 3 or 6 months. So although we might think GDP is kind of all right right now, consumers are telling us that they're stressed, they're worried. If you're worried about your job, if you're worried about your credit card bills, if you're worried about your housing affordability, what happens? You don't eat out so much, you don't change your car this year, you travel less, maybe you skip the holiday, you don't buy a new sofa, you don't refit the kitchen, all of those things, that in a normal health economy, they go down. We park those, we're just going to concentrate on the essentials. And that's what we're about to see. And sensibly, it makes sense that once we see consumers stressed like they are right now, in a 3 to 6 month lag period, this is what we're going to see in the US economy. Okay. And by the way, it's not just the US. So here is the Ipsos survey, again from last month. This is the year-on-year changes in consumer confidence with the largest national reductions in consumer confidence. We can see India, negative 9.2, Japan, -4, Canada, -2.7, France and Brazil down here. Why are these important? Because all of these ones with the asterisk, they're members of that top 10 global economy that we looked at earlier. Okay, this doesn't look good. Not predicting the future, we're just pattern matching. Is gravity going to do its job? Who knows? Okay, actually, I missed a slide somewhere. Maybe it'll come back. Okay, right. I'm actually doing okay for time, I think. Okay, so we've kind of exposed that we can't predict the future, we can't read people's minds, it's a waste of time trying to guess which way the Mini is driving on the deck of the supertanker. We're more interested in reading and understanding about the economy itself, because that's the direction of the supertanker is what counts. So we can be aware of it, we can factor it in, we don't necessarily know for sure until we see the data. But there are some things that we can do and we should do as investors, as savers, as retirees, just to make sure that we're covering our bases. And this is about preparation. It's not about predicting the future. This is about preparation. The first one is just the basics, which I touched on in January, is asset allocation. If I'm an adventurous investor, or I'm already high net worth and I've got a kind of a play portfolio, I might consider myself quite adventurous as an investor. Or maybe I'm a youngster, I'm in my 20s, or a young executive, I've got a long time horizon, I've got time in the market, as they say. I can afford to have quite a high percentage of my investments in, I just realized I'm blocking your view. I'll move over here. I could probably afford to have a high percentage of my portfolio in equities, which is where the volatility, where the risk comes from. On the other hand, if I'm retired or close to, or I've stopped work, or I'm just a naturally cautious person, I might not have so much exposure to global equities. Well, that's our asset allocation. And for those who were here in January, you might remember this slide, just an example, very, very simple. Bonds, safe and steady, very boring. Equities is where a lot of the growth comes, but highly volatile. We can mix, we can do a 60-40 or a 70-30 or whatever, and we kind of get growth that we're happy with without the volatility when things go a bit crazy. And just as an example, here's three investment portfolios, same assets, just the split. The green one is 65% equity, the red one is 50% equity, the blue one is 35% equity shares. And we can see, everyone wants a result like that, but if we're here and we have to suffer that kind of decline, it might make us feel a bit uncomfortable. Whereas the blue one, if I can only withstand volatility like this, I might have to sacrifice gains and be happy with those level of returns. Asset allocation, very basic, looking at a portfolio, taking account of our own personal risk profile as investors, and also what's going on in the general economy. It's something that everyone needs to do on a regular basis, and certainly when there are alarm bells ringing in the broader economy. Okay, that was basic preparation. Intermediate preparation, this is very cool. I'm going to show you the black magic of the investment world. So I've got two investment funds here. Fund A starts at a unit price or a share price of 100, and Fund A grows at 2% per month. This is a 12-month horizon. 2% per month, so the price is 100, 102, 104. It's growing like that, and at the end of the year, it's grown to, share price is now at 124. On the other hand, Fund B, I'm going to stop blocking you guys so you can see the screen for a while. So on the other hand, Fund B has an awful year. It tanks by about a third. So in the middle of the year, 6 months in, the share price is about 68. But then it manages to recover. But at the end of the year, it's got back share prices of 100. Okay, so Fund A, steady growth at 2%. Fund B, awful year, tanks by a third, and only just recovers to where it started. Now, here's the question. Imagine I'm saving $1,000 a month into each of these two funds. At the end of the year, in which fund have I accumulated the most value? Have I now got more value in Fund A, or have I now got more value in Fund B? Okay, it's kind of an optical illusion because everyone thinks, well, it's got to be this one, hasn't it? Not necessarily. Let's look. And the reason is, when prices are low, our $1,000 is buying more shares and lower prices. So we're leveraging up. Here's the detail. So let's look at Fund A. Here's our 12 months. Here's our share price, our unit price going up by 2% each month. Here's our $1,000 a month. Now you can see as the share price goes up, we're buying, or the unit price goes up, we're buying gradually fewer and fewer units for our $1,000. But at the end, we've accumulated 107. 107 times the current price means that we're up $1,400. That's kind of okay, isn't it? Yeah. Here's Fund B. When the share price, or the unit price, goes down and it's down in the 60s, our $1,000 is buying, at lower prices, is buying more units. So let's say 6 months in, we're buying 14.5 units versus only 5 over here. So at the end, we've accumulated more units. We've now got 153 units versus 107. Value is the share price times the number of units. We're up 3.3. We've made twice the profits with Fund B than we have with Fund A. That's dollar cost averaging, just simple averaging into that. Now, I say it's the black magic of the investment world, but it only works in certain cases. It only works if we expect prices to recover in our time horizon. Okay, so if I'm a new saver, if I'm that young executive and I've just got a promotion and I'm starting, retirement savings, this is a great strategy. But if I'm, in on the plan or I'm closer to retirement, we can't rely on this. The other thing is, it works for new money, not money that we've already accumulated. So it's great. This is often missed when people talk about dollar cost averaging. In fact, this is quite an important point. Let me just go back. Okay, so this chart all looks really great. It looks fantastic. I've got new money going into these funds, but imagine I've already been working hard. I'm a few years in, and I've already got 100,000. So on that day of the month, I've already got 100,000. And this is my regular savings plan. Dollar cost averaging works for the new money that I'm putting in, but that 100,000. It goes down and then it comes back up again. That 100,000 over that 12 months has shown no gains at all. Sure, the new money has, but the 100,000 doesn't. So if we're long-term savers and, we read all this great stuff about dollar cost averaging, how fantastic it is, sometimes we need to look at the money that we've accumulated and just make sure that it's parked, actually either working for us or appropriately defensive. Okay. Advanced. Doing well. Okay, so preparation 3, advanced preparation, is capital preservation. Now, this one might be relevant to a number of us in the audience. So we're all familiar with the expression, it's time in the market that counts, not timing the market, whatever. So that phrase, everyone's heard of that, time in the market counts, not timing the market. Are we all familiar with that? Kind of, yeah. So it's one of those things that it's a trite phrase that's stripped out, and it helps people to kind of be calm when we got market volatility, but it's not always right, because the concept of timing the market means that, I'm going to get in and then I'm going to get out and then I'm going to get in and that's not the way I see timing the market. I just see timing the market as I'm not trying to predict it, but I'm pattern matching, and you know what? I feel a bit nervous, so I'm going to take some chips off the table. Yeah. Or I feel very optimistic. GDP is going well, consumer confidence is going up. Maybe I'll increase my asset allocation. Making those subtle changes to take account of our best guess or pattern matching about the economy is not timing the market. So it doesn't mean we shouldn't do it. So these guys say, stock market delivers 8 to 10%. I don't need to worry about it. That's over the long term, because time in the market only counts if we actually have time. Now, if you'd have invested at the peak of the dot-com, and people were taking out debt, or they were selling assets to invest, because there was this fancy thing called the internet at the time, whatever that is, and they were saying, oh great, this is going to be good. Now, if you'd invested in the S&P 500, and a gentleman picked this out, so I've laid all the chart, in January, said, is that dividends included? Yes, if we'd invested and we'd included dividends, so dividends reinvested, we invested in the S&P 500, it would be almost 7 years before we break even. Okay, so time in the market has no place if this is our retirement fund, whether we're close to retirement or later. And then, of course, we got the global financial crisis, and we've got another dip. So it's another 5 years almost before we're there. And basically, from the 24th of March 2000, we're almost 7 years to break even. After 10 years, we're still negative compound average growth rate. We're negative almost 1% after 10 years. So there, 10 years is around about there. Negative 10 years. At 15 years, our average annual growth rate has only been 3.5%. 15 years for 3.5% returns from the S&P 500. Time in the market, we need to be very careful about what we're trusting. And at 25 years, up to now, our average returns would still be underperforming that mythical average return of between 8 and 10% from the S&P. So we're not predicting, we're not timing, we're just being aware of what's going on so that we can make decisions that help us sleep better at night. Okay, I'm going to compare two retirement funds. So I've got Retiree A and Retiree B. They're both in very similar situations. They've got a retirement portfolio of $1 million, and they're going to withdraw $50,000 in the first year, and then increase that by 3% inflation each year for the next 20 years. And both of them, with their investment strategies, get an annual average return, a compound average growth rate of 4%. However, the sequence of those returns is different. So Retiree A has 3 years of pretty good returns, 13%, then a kind of like neutral 5.5, then 3 years of negative 10%, then some more 5.5. Retiree B has the kind of like the mirror image. So his first 3 years, or her first 3 years, are negative 10% for the first 3 years, then the same 5.5, then positive 13, and then the same 5.5. So both retirees, at the end of 20 years, their investment strategy will have delivered exactly the same returns, net annual average of 4%. Which retiree is going to be in the best position at the end? Because remember, retirees, we're not putting money into our plan, we're taking money out. Let's just have a look. Okay, here we are. So there is our start point, day one. And Retiree A, Retirement Fund B, has 3 good years, 13% growth. Then relatively, kind of boring, 7 years at 5.5. Then comes that downturn, 3 years of 10%, and then a kind of a tail off. So at the end of 20 years, Retiree A has still got, about half his money left in the 500k region. Retirement Fund B, or Retiree B, the day he retires, suddenly the markets drop. His investment strategy is minus 10. And by the way, I can't remember, I put it on the slide, the average market decline associated with the recessions for the last 50 years is more than 30%. So it's much more important to be aware of the risk of recession rather than trying to guess Trump's mind. So imagine we retired at the start of the dot-com bust. We got several years of market decline, but here this guy only has 3 years of 10%, but then the returns are here. But the problem is, when you're retired, you're not putting in, you're not taking advantages of low prices. They're working against you because you're forced to crystallize losses when prices are low. And because you've depleted your pool, when prices rise back up again, you're not getting full benefit. So you can see, I don't need to tell you, this guy runs out of money unless he changes tack, eats out only once a week instead of 3 times or whatever it is. He's going to run out of money before the 18th year. This is just basic maths, but it's one of the reasons why that retirees do get wrong. We're too optimistic. So as retirees, we're withdrawing, not accumulating. We're forced to crystallize losses when market's down. We got no choice. That's our retirement fund. We need to pull it out. Asymmetry of returns works against us, because if we lose a third of our money, like the average decline in a recession, We need to make 50% gains just to get back to where we were. Start with 100, third down takes me to 66.3. I need a 50% gain to get back to 100. Now that's asymmetry, and that's a tall order, because you need to take a lot of risk to get that. So if we're close to or in retirement and we haven't thought about this, and we do suffer a market crash, what do we got? Maybe, I don't know, an extinction level event. I'll just put this there because I came across a graphic and I liked it, so I thought I'll put it in here. Okay, so when we retire, we need to think about stability of returns. So I've added in here Retirement Fund C and Retirement Fund D. Completely boring. Remember that I said that the average annual return of A and B is 4%. Well, what if we just put in 4%? Nothing, just fixed 4%. It would decline like that. So at least, so I haven't shot the lights out. I'm down a bit from this guy, but I haven't depleted all my assets. I'm still here. So you might be in the position where, you know what, if I can get say 4-5% without exposing too much market risk at the time, I might as well do that. And here is the 6% I've just illustrated. We get a stable 6%. Okay, it's higher than the 4%. But it just shows you this guy has still got, he's only down 10% over 20 years. And it's not unreasonable to be taking out an index-linked 5% from your retirement assets each year and still end up with a decent chunk after 20 years. That's kind of a decent return without any market risk. So these are the kind of things that we need to think about. Moving on. Okay, the next one, I'm still working to time. So this is a way of thinking about how we plan our assets in retirement and where our income is coming from, where our growth is coming from. It's not for everyone. I call it SML, which is easy to remember because you've got short, medium, and long. But the way to think about it is spend, maintain, and longevity or legacy, depending on your circumstances. So spend is a window. You might have heard of like the buckets, retirement buckets is something if you Google it. I think that's a bad analogy. I prefer to think of it as like a window because this is sliding every time. The first 2 years, what we're saying to ourselves is, okay, imagine all hell breaks loose, markets go crazy, where is my income going to come from for the next 2 years? Or maybe 3 years? Because if I know where that income is going to come from and it's not exposed to the markets, I'm kind of like, I can relax. So the spend is where am I going to be spending from for the next. I've just realised I actually prepared some slides on this. Okay, so the spend is my near-term living expenses. So I've got something to live on now. That could be term deposits, money market funds, saving accounts, whatever. But by having enough to call on that isn't invested in a traditional portfolio, we're kind of like protected against, what might happen. Okay, next one. So what is the maintain? So the maintain window is a window that starts from about year 3 and it's, somewhere between another 5 to 7 years. So it's kind of like from year 3 to about 8 to 10 from now. And because we've already got we've de-risked our short-term retirement income, we can afford to be a bit more conventional in the way we plan our finances for this window. So we could just have a standard balanced portfolio matched to our risk profile, quality fixed income investments, diversified equities, that kind of thing. And we can ride out, as long as we got the super tanker direction right, we can ride out the volatility that comes from madness of global decision makers. And every so often when we review, if the portfolio is done okay, we can take some money out of the maintain and drop it into the spend, de-risk it, put it in something safe. And then the final one is the long term, call it longevity, if we plan to live for a long time, or legacy, if we want to think about what happens to the next generation. So this is starting from a window about 8 years plus with no defined end, because remember we're reviewing it every year. And this can be a holding for more illiquid or more risky assets. So if we like real estate, or we like private equity, or we've got, direct investment in, smaller companies or whatever, it's the kind of thing where we're looking for capital appreciation over the long term, counteract inflation, and we do quite well. We can move some down here. If things don't quite go to the plan, that's fine. The next generation can deal with it. That kind of thing. So I've just put this up here because it's something that I do with a number of clients. As I say, it's not right for everyone, but just think about ways, given the pattern matching that we can, sense for the direction of that supertanker at the moment, what are the kind of things we might think about? And if we do that, what it means is that we're a bit more relaxed and a bit more comfortable because we're not predicting the markets. I can't read Trump's mind. I can't, imagine, President Xi, what they're going to do. Trump made one announcement, everything is great, we've got a deal. No, they didn't have a deal. All they've done is paused things for 90 days. And the average tariff is still somewhere between 30 and 40, depending on whose data you believe. That's not a deal. That just moves everything down. There's so much uncertainty. What we're more interested in is understanding where the supertanker is rather than trying to guess, those peaks. If we can prepare rather than predict, we'll be much more calm as investors, and we know where our income is going to come from when we need it. And that's all I've got left is to say thank you very much for your attention. I was a bit quicker this time, Ren. Thank you.